If you have ever thought, I want to start investing, but I don't know where to begin, or I want to invest, but I'm afraid of losing money, you are not alone. Most beginners feel overwhelmed by stocks, bonds, inflation, and risk. It can feel like learning a new language. But what if I told you there is a book written over 70 years ago that still holds the exact roadmap for how smart investors build wealth today? A book that Warren Buffett himself calls the best book on investing ever written. A book that has quietly made more millionaires than any flashy TikTok stock tip or so-called YouTube money gurus ever have. It's called The Intelligent Investor by Benjamin Graham. And in the next 20 minutes, I'm going to break it down in the simplest, most beginner-friendly way possible. No jargon, no hype, just timeless lessons on how to grow your money steadily, safely, and smartly, even if you're starting from scratch. This summary is exactly what you need. Part 1. Investment versus speculation. Benjamin Graham, the author of The Intelligent Investor, clearly distinguishes between investing and speculating. Understanding this one difference can literally make or break your financial future. Investing means putting your money into something that has a solid foundation, something you've studied, something you believe has long-term value. You're not trying to get rich tomorrow. You're trying to grow wealth slowly over the years by making smart, informed choices. Speculation, on the other hand, is more like gambling. You're buying something just because you hope the price will shoot up soon, often based on hype, rumors, or trends. You're not focused on the actual value of the business. You're focused on the price chart. Let's say your cousin Janet buys Dogecoin because it's trending on Twitter, and Elon Musk tweeted a meme about it. She has no idea what it actually is, but she's hoping its price will double next week. That's speculation. Now let's look at Mark. He buys stock in Tesla because he has read financial reports, looked at their earnings, and believes the company will keep innovating over the next 10 years. He's not worried about short-term ups and downs. He's thinking long-term. That's investing. They're both buying an asset, but driven by two completely different mindsets. Graham emphasizes that speculation isn't evil, but it is dangerous when you do not realize you're doing it. Most people think they're investing when in fact, they're just guessing. And when markets drop, and surely they will, they panic and lose everything. So how can you tell the difference? Ask yourself this: did I make this decision based on facts and analysis or feelings and hype? If it's the first, you're investing. If it's the second, you're probably speculating. Graham's advice? If you do want to speculate, fine. Just treat it like a side bet. Use a small amount of money and never confuse it with serious investing. This idea alone, knowing when you're speculating, can save you from falling into emotional traps that wipe out your entire savings. Part 2. Understanding Mr. Market. Imagine you have a business partner named Mr. Market. Every single day he comes to you and offers to either buy your share of the business or sell you his share. But here's the twist. Mr. Market is emotionally unstable. Some days he's super excited and thinks the business is worth a fortune, so he offers to sell you his shares at a very high price. Other days he's depressed and thinks the business is worthless, so he'll sell you his shares at a very low price or offer to buy yours at a bargain. The important part? Mr. Market's mood changes all the time, but the value of the business doesn't change that quickly. You don't have to accept his offer. You have the power to say yes, no, or do nothing. Benjamin Graham uses this idea to explain how the stock market behaves. Every day, stock prices go up and down. Sometimes people get too excited and drive prices way too high. Other times, they panic and sell everything, making prices fall too low. Here's the lesson. You don't have to follow Mr. Market's emotions. In fact, you can use them to your advantage. As an intelligent investor, your job is to 1. Take advantage of Mr. Market's irrationality, not get swept up in it. 2. Buy from him when he's scared and selling cheap. 3. Sell to him when he's super excited and willing to overpay. 4. Never base your valuation of a company on Mr. Market's feelings. But you're never forced to act. You can choose to ignore him completely until he offers a price that makes sense based on the true value of the business. Think of it like this. If someone tried to sell you a $10 sandwich for $50, you'd just laugh and walk away, right? Same idea. Stocks are no different. Don't buy just because the market is excited. Buy because the value is there. This simple idea, treating the market like an emotional partner, can help you stay calm, make smarter decisions, and avoid the common mistake of chasing prices based on fear or hype. In early 2020, when COVID hit, airline stocks dropped like crazy. Delta, for example, fell from over $60 a share to under $20 in just a few weeks. Mr. Market was terrified and thought the world was ending. But if you believed Delta would survive long-term, you could have bought it while everyone else was running for the exit. Fast forward 2 years, and the stock more than doubled. Mr. Market is there to serve you, not guide you. You don't have to buy or sell when he does. You wait until he offers something worth your time. So next time the market crashes or a stock price suddenly jumps, just imagine your nervous business partner knocking on your door. Smile, thank him for the offer, and only act when the price is right. Part 3, the margin of safety. This might sound like a technical term, but trust me, it's simple. In fact, you already use this concept in everyday life, probably without even realizing it. Let me explain with a quick example. Imagine you're buying a secondhand car. You do your research and find that a specific model in good condition is typically worth around $10,000. Now let's say a seller offers it to you for $6,500. What's your first reaction? You probably think, wow, that's a great deal. But why? Because you've got room for error. Maybe the car has a few scratches, perhaps it needs new tires, or perhaps the brakes need fixing. But since you paid well below its real value, you're still protected even if something goes wrong. That price gap, the difference between what it's worth and what you paid, is your margin of safety. Let's bring that into the world of stocks. Say you've studied a company and believe its true value, called intrinsic value, is $100 a share. But today, the market is offering it at $70. You've got a $30 margin of safety. So even if the company hits a rough patch or the market dips for reasons you can't control, you've left yourself a cushion. You didn't pay full price, so your risk is lower. This is exactly what Benjamin Graham, Warren Buffett's mentor, talks about. He says, no matter how careful you are, some things will always go wrong. So buy with a margin of safety. In simple terms, a margin of safety means only buying a stock when it's priced far below what it's truly worth. It's like buying peace of mind. Think of it like wearing a helmet while biking. Most of the time you won't fall, but if you do, that helmet could save your life. Buying a stock only when it's undervalued gives you protection. Because even if the company struggles for a bit, you didn't overpay. Graham's point is this: nobody can predict the future perfectly. Even the best investors get things wrong. But if you always invest with a margin of safety, your chances of permanent loss go way down. And here's the kicker. Most people ignore this rule. They chase hype, follow trends, and buy stocks when prices are sky high. Graham is saying, don't do that. Be patient. Wait for the right opportunity when the price is low enough to give you a buffer. Because smart investing isn't about being aggressive. It's about being cautious when others aren't, and making sure the odds are stacked in your favor. So next time you're thinking about buying a stock, ask yourself, is this a bargain or am I paying full price with no safety net? That's the mindset of an intelligent investor. Part 4, Investor Psychology. Imagine you're at a mall. There's a shoe sale. Everyone's rushing in, grabbing pairs, even fighting over them. You weren't planning to buy shoes, but suddenly you need to get one before they're gone. Now replace shoes with stocks. That's how most people invest. Benjamin Graham, the man who mentored Warren Buffett, believed this. The biggest danger in investing isn't the stock market, it's you. It's your fear. It's your greed. Imagine this. You buy a stock, let's say it's a company you believe in. You did some research and you're confident it's a solid investment. But a few weeks later, the market drops. The stock goes down 10%, then 15%, and now you're panicking. You open your app, see all the red, and your stomach sinks. You start thinking, what if it keeps going down? What if I lose everything? So you sell it, just to stop the bleeding. A few months later, the stock bounces back and even goes higher than where you bought it. But you're out. You sold low and missed the recovery. Sound familiar? That's fear in action. Now flip the script. Let's say the market's booming. Everyone's talking about a hot stock. Maybe it's a tech company or the latest AI startup. You see it going up 10%, 20%, 30% in just a few days. Your friends are making money. TikTok is hyping it. FOMO kicks in hard. So you jump in, not because it's a great company, but because it's going up. You want in on the action. But right after you buy, the price drops. Turns out it was all hype, and now you're stuck with a loss. That's greed at work. Here's the truth, Graham teaches. Smart investing is not about reacting. It's about sticking to a plan based on logic and facts, not headlines, emotions, or the latest trend. The intelligent investor doesn't get swept up in panic or euphoria. They don't chase hype, and they don't dump good investments just because prices fall temporarily. They understand that the stock market is like a mood swing. Sometimes it's exciting, sometimes depressing, but none of that changes the actual value of a good company. It is kind of like buying a house. If your neighbor tells you one day that your house is worth 20% less, would you panic and sell it immediately? Probably not. You know your house is still solid. You still live in it. Nothing's changed except his opinion. That's how you need to think about stocks. Graham's advice? Build emotional discipline and have a strategy. Know why you're buying something and stick with it unless the fundamentals change. Because at the end of the day, your biggest investing advantage is not about being smarter than everyone else. It is being more rational when others are losing their heads. Part 5. Defensive versus enterprising investor. Let's say you have some money saved up, maybe from your job, a side hustle, or even a lucky bonus. Now you're thinking, should I invest it? Great question. But before you jump in, here's the big choice Benjamin Graham talks about. Are you a defensive investor or an enterprising investor? Let's break it down with an easy real-life example. The defensive investor. Sarah works a full-time job, she's busy, and honestly, she doesn't want to spend her weekends reading company earnings reports. She wants her money to grow safely over time, but she doesn't want to constantly check the market or stress over which stock to buy. For people like Sarah, Graham says, keep it simple. He recommends a mix of high-quality bonds and reliable big company stocks. For example, blue-chip companies like Coca-Cola, Johnson & Johnson, or Apple. Use index funds if you don't want to pick stocks. The goal is to minimize risk, avoid big mistakes, and let time do the heavy lifting. In today's terms, Sarah might put 60% of her money in a broad U.S. stock market index fund and 40% in a bond fund. Once or twice a year, she checks in, maybe rebalances her mix, and moves on with her life. No stress, no guesswork. This is like putting your money in a slow cooker. Set it, forget it, and let time do the work. Then there's Mike, the enterprising investor. Mike is a numbers guy. He actually enjoys digging into financial statements and researching companies. He's not afraid to go off the beaten path to find hidden gems in the stock market. He knows it takes time and effort, but he's willing to do it. For people like Mike, Graham says, go for it, but do it wisely. Being an enterprising investor means you're not just buying the big names. You're looking for undervalued companies, stocks that are being overlooked by most people, but have strong potential underneath. It's kind of like finding a designer jacket in the clearance section. You're getting quality, but at a discount. Let's say Mike notices a solid small tech company that's trading at a really low price because it had a rough quarter. But when he checks the numbers, he sees the company has zero debt, loyal customers, and a strong plan. That's the kind of opportunity Graham wants the enterprising investor to look for. This approach is not for everyone. It takes time, discipline, and the ability to tune out market noise. If you don't enjoy it, you're more likely to make bad choices. So what's the key takeaway? Graham is not saying one approach is better than the other. He's saying know yourself. Are you a Sarah or a Mike? If you won't put in the effort, don't fool yourself. You'll do better being defensive, investing passively, and staying the course. But if you truly love the research and you're ready to put in the work, being enterprising can pay off. Most people think smart investing is about picking the right stock. Graham believed it's more about knowing the right strategy for you, and that's what makes this part of the book so powerful. It's not about chasing trends, it's about building a plan that actually works for your life. Part 6. Stock selection for the defensive investor. For defensive investors, Graham lays out specific criteria for stock selection. 1. Adequate size of the enterprise. Avoid small risky companies. 2. Strong financial condition. Look for companies with low debt. 3. Earnings stability. Profits should be consistent over at least 10 years. 4. Dividend record. Companies should pay regular dividends. 5. Moderate PE ratios. Don't overpay for earnings. 6. Moderate price-to-book ratios. Avoid overvalued companies. By sticking to these guidelines, the defensive investor avoids riskier plays and sticks to the fundamentals. Part 7. Stock selection for the enterprising investor. Enterprising investors can dig deeper. Graham suggests looking for 1. Undervalued stocks with strong fundamentals. 2. Net stocks. Companies trading below their net working capital. 3. Special situations such as mergers, spin-offs, or reorganizations. But again, this approach takes time, patience, and discipline. You can't be swayed by hype or short-term fluctuations. As we wrap up, here are a few timeless lessons from Graham. 1. Be skeptical of market predictions. Most experts don't know what the market will do. 2. Focus on value, not price. A cheap stock isn't always a good buy. Look for quality and fundamentals. 3. Stay disciplined. Have a plan and stick to it. Don't get swept up in market euphoria or fear. 4. Invest for the long term. Time is your best ally in building wealth. And perhaps most importantly, the intelligent investor is patient, rational, and always learning.